So good afternoon, everybody. My name is Tom Sullivan. I lead digital assets at DTCC, and I'm really excited to be here to share the stage with these gentlemen to talk about stablecoins. And I would firstly like to say that thank the Thai team for doing an awesome job. It's another great event, so thank you all. And without further ado, I know we don't have too much time to get through, so I'll let my panelists introduce themselves, and then we can get into some fun discussion. David?
Thanks, Thomas. I'm David. I'm co-founder of Xe. We streamline access to crypto yield, and I'm sure we'll talk about that some more here in a little bit.
Afternoon, everybody. Anthony Bassili, president at Coinbase Asset Management. We are a wholly owned investment manager by Coinbase Global. We run strategies onshore in the US and offshore. Our strategies are Bitcoin yield related, stablecoin yield related, tax loss harvesting, managed accounts, and we have indices that we've created as well. It's great to be here.
Hey everybody, Raja Chakravorti. I'm the Chief Business Officer at the Stellar Development Foundation. We are a layer 1 blockchain that is hyper-focused on payments, focusing on cross-border, available across 170 countries, and hyper-focused on tokenization. And it's really exciting to be here with these esteemed panelists.
Hey everyone, my name is Feng. I'm partner at CoinFund, which is a Web3 native VC investing at the pre-seed, seed, and Series A stages. Prior to Web3, I did long-short equities, first at Citadel and then Point72 on a couple of TMT teams.
Great, thanks guys. So before we get into the questions, I'm just going to have to indulge me. I have a little anecdote, and hopefully we can tie it in at the end. So last week I was watching Jeopardy, and one of the clues was my favorite commencement speech. And so if anyone was wondering how much of a nerd I am, the fact that I watch Jeopardy all the time, I love crypto conferences, and I have a favorite commencement speech, now you know. And so David Foster Wallace gave a speech 20 years ago or so, and the story goes, and I'm going to read it just to make sure I get it right. There are these two young fish swimming along, and they happen to meet an older fish the other way, and he said, "Morning, boys, how's the water?" And the two young fish swim on for a bit, and eventually one of them looks to the other one and says, "What the hell is water?" So, we'll park that for a minute and just, thinking about what stablecoins are and what they will be in relation to money. But, okay, so in the backdrop of the Genius bill that passed this year, obviously there's been a lot of attention to that. There's a lot of excitement around that. So what are the current use cases that we see, and what are the evolutions that we're seeing in terms of broader adoption? So maybe, Raj, I'll start with you.
Yeah, I mean, when I think about, by the way, I think that's a great kind of quote in perspective. When I look at what a killer use case is, for us, it's just been everyday financial services, right? Like kind of the basic stuff. Obviously, there's been tremendous product market fit on the remittance side. There's been product market fit on cross-border payments. So all of that stuff, I think, is there and is for the taking. I think the things that we continue to see that are emerging, certainly, B2B, treasury management, those are kind of the next state things. But what we're looking at is a lot of efficiency, and we're seeing tremendous growth. Obviously, I think stablecoin issuance went from 0 to 250 billion or so, maybe north of that over the last 5 years. On Stellar, we've actually seen 88% growth just in the last year in terms of stablecoin payment volume, and so just tremendous trajectory that is happening on those core use cases. And I think the reality is where we're seeing a lot of value is in the places where stablecoins and kind of the concept of blockchain is kind of obfuscated from the end use case. So like the canonical example we like to think about is the MoneyGram use case. So MoneyGram is a really significant partner of Stellar, and the way in which we partnered is there's 150 million users of MoneyGram using their remittance service, being able to send a digital dollar from the US to one of the important corridors, let's say it's somewhere in LATAM, and then the end consumer can go ahead and just cash out in fiat. And everything happens under the hood. It's a digital dollar, it's a stable coin, but the utility has basically been obfuscated, which I think is similar to that concept of like, what the hell is water?
Great. Anyone else? You guys, any additional thoughts on this?
Just as a matter of perspective, so I've had the pleasure of being in the space for quite some time, and prior to Genius, I don't think it's an overstatement to say that crypto was actively under fire in certain jurisdictions around the world. And with Genius passing, it has certainly opened up the floodgates for more interest, more institutional adoption, and I think that's been represented in the stablecoin growth. So yeah, just as a matter of perspective, it's been a watershed moment in the industry.
And you're asking use cases, right? So I've got a billion use cases. Personally, I like to send money on the weekends to people. We've got a guy who mows our lawn, and we pay him in stablecoins. Our general contractor who has to pay his folks, he pays them in stablecoins. It's not the easiest process today, but he doesn't have to go to a bank and send money through wires or do any of that stuff. We've got, when I bought my house in 2020, I was very long Bitcoin. I borrowed against my Bitcoin to go pay for my house when the banks were closed. And I didn't have to go into a branch and talk to anybody. I didn't have to get an appointment. You just think about the real world use cases of how the technology solves really basic problems, and then extrapolate that into what institutions are doing. So at Coinbase, our treasury business, we run billions and billions of dollars of trade finance infrastructure. We're handling wires out the door. We have money coming in from hundreds, over 100 million customers. And all that runs 24/7, 365, right, as an institution. So whether it's me as an individual looking for ways to have liquidity against my assets, or just send money nights, weekends, holidays internationally, or it's a corporation looking to constantly run their business real-time 24/7, that's the big use case.
I guess, so my other panelists have already touched on some of the more obvious use cases, so I'll throw in there as well. I think incremental to what was said, I do believe stablecoins, especially given the heavy dollar dominance, does represent one of the more interesting kind of foreign policy tools that the United States has as well, in terms of force projection and really soft power projection, especially because it's always on an opt-in basis. So that's certainly something interesting, in addition to obviously the other use cases that we've talked about and we've invested behind.
Thanks. And so maybe, along those lines, and when you think about infrastructure versus profit generator, and both from a use case perspective, when we think about the trajectory, both I would say the total dollar values that are outstanding, but also in terms of the issuers. So who are the issuers going to be, in the future? Now there's a limited concentration of the issuers. Will there be hundreds of issuers? Will there be thousands of issuers? Will every bank and every corporate have their own stablecoin? So I'll just throw it out there, whoever wants to jump in first.
Maybe I'll start. I don't think it's going to be thousands of issuers. I think what we're seeing is there is a lot of stuff just from like a regulatory perspective, from being able to ensure that you've got the reserve requirements necessary. And so I think that concentration of issuers should probably kind of shore up into tens, maybe a couple dozen. But I think for those issuers, they're the ones who are really going to be focused on, okay, what are the things that I want to be able to do? Right now, I think the reason why issuers are issuing stablecoins, they have the opportunity to earn yield for themselves. It's a profit generator for them. Depending on what happens with rates, like some of that shifts and it becomes more of a utility function. And I think that's going to yield a lot of different innovation around different other asset classes outside of stablecoins. And so you'll start to kind of find your swim lanes of like, what is a stablecoin versus like, what is a tokenized yield-bearing asset and what that does. And I think they'll have their own areas.
Anthony, we were talking a little bit before about the distinction between yield-bearing assets and otherwise. And again, piggybacking on this question, and maybe there's a different way to look at it. You can see in the press and things like that, like large banks are saying, yeah, everyone's gonna issue stablecoins. Is that gonna be real? Not sure. But how does that dovetail to the things that you're seeing at Coinbase from a usage standpoint?
So I'll speak from the asset management side, and which means I'm agnostic as to whose stablecoin it is and whether it pays yield or not. And this is just technology. I think I take the opposite tact of Raj, which is I think you're going to see a mass proliferation of new stablecoins. You're going to see hundreds, maybe thousands of new stablecoins coming in. Every major corporation that has spent billions and billions of dollars to capture their customer and keep them integrated into their ecosystem more and more and more, given the big technology bear hug, now has the opportunity to create their own stablecoin and integrate that into their own merchants payments portal, and then create an entirely new revenue line. And I think you're going to see every major corporation explore that in some way. Now, whether or not the stablecoin itself is successful and makes it outside of their ecosystem and is something that we use day to day on open, public, permissionless highways across these blockchains is the big question. And that's where the network effect conversation comes in. So you're right, there's probably a handful of issuers who will maybe continue to dominate the public market network effect of freely transferable and liquid stablecoins. But you're going to have a lot of these little ecosystems where you might have to swap from one stablecoin to another. And most of that swapping activity will probably be obfuscated away from the consumer and their wallet. And so there's a lot of different technology layers that already exist that are building, and they're early stage companies now, but they're building to be that interchange mechanism to be able to support liquidity going from one ecosystem to another.
So Evan, we've got lots, but both you guys, David and Evan, I like your opinion. So somebody's going to be right. I want to know who.
Yeah, I mean, not too differentiated here in that our view is it's probably a Pareto distribution, but to double click on that a little bit more, I think some of the inputs that predict maybe who the ultimate winners are include effects like the Lindy effect, essentially that the stables that have been around and have been battle tested will likely still defend a lot of their market share. And then I think another ingredient is obviously liquidity, and that's probably the angle by which some of the new entrants, whether corporate-backed or partnership, JV-style announcements that we've seen, are going to try to build a beachhead to maybe start the flywheel and catch up to the distribution that we've seen. But at least as it relates to CoinFund, I think some of our investments, both announced and what we're diligencing, does center more, to Anthony's point, at different layers of the stack, kind of higher up, maybe closer to either the consumer or from an aggregation cross-border perspective, especially ones that maybe have a unique advantage working with partners in a geographic region or solving a particular business or consumer problem, as opposed to the issuance itself, which, as we've noted, is sensitive to a lot of things and where market share is probably a little baked right now.
I'll just give a quick example, sorry. So today, JP Morgan announced that they had just launched their JP Morgan tokenized deposit coin on Base. So it's their first foray into another layer 2 like public network. And so what that means is if you all are JP Morgan customers, they're probably going to come to you inside of your app or on the website at some point, and they're going to say, we're going to, thanks for all of your transaction activity. By the way, in your terms of service, we want you to know that we're now supporting JP Morgan coin, which can be utilized in a wallet. It's a permissioned asset, which means you can't freely transfer the JP Morgan coin to any other wallet, but you will be able to use it, and there's a swap facility that lets you sell your JP Morgan coin for USDC. And so you, as a user in a wallet, are going to be able to bank with JP Morgan and then transact with a third-party Web3 application. And that transaction happens behind the scenes across the blockchain from JP Morgan, no longer Onyx, Connexus, to Base. It might be obfuscated away from you. You don't really care. At some point, you're not going to ask the question, but that's kind of how the pipes are working today.
Yeah, the technology has democratized the ability for anybody to launch a name-branded stablecoin. So the obvious outcome there is that everyone will go and launch one. The two people who ultimately win are, one, the people who provide the liquidity, the swap facilities, the redemption ability, like 24/7 against other more fungible currencies like USDC outside of that captive audience. And then two, people that own the relationship with the customer.
Great. So I mean, it seems like there's both thinking about it as infrastructure, meaning that you need to have this tool within your ecosystem, but also it's a means to retain customers and maintain profitability, even if it's not directly from the stablecoin itself. Is maybe one of the messages I'm hearing. Along the lines of profitability, obviously the profits come from the reserves. The reserves, you get yield on the reserves. Typically, no yield will be paid, and the Genius Act, as it's written, implies that stablecoin issuers won't be able to pay yield, or does it? So maybe, Evan, I'll start with you about this question, in terms of yield and how the stablecoins pay, and what happens, in that regard when there's other scenarios. And then David, from there to you.
Yeah, this is a good and very kind of deep question with a lot of business implications. So yeah, the Genius Act, does require, or I think it's specifically kind of it isolates the use case to permitted payment stablecoin issuers to essentially not be able to confer yield or kind of harvest yield and kind of have that accrue back to the stables. I think what that really opens up is opportunity for others, perhaps money market fund wrappers, etc., especially to act as additional intermediaries. We're investors, for example, in a company called Superstate that does something similar. So I think it's a bit of maybe a reflection of certainly the power of the bank lobby and maybe from their perspective the need to protect depositors. But I do expect over time, as there's maybe enough white space for innovators to try to combine the best of both worlds, at least as it relates to an ultimate consumer offering, that I think the lines do blur, even though they're maybe legislatively defined for now. And certainly we'll see some, I think, innovation continue.
To build on Evan's point, I think this is why, for me, a really interesting asset is like Franklin Templeton's Benji asset. And so Benji is a tokenized money market fund. What they've been able to do is they actually created the ability to offer intraday yield. And so that's a really exciting innovation. They can do it 24/7, 365, and that ability, they can calculate yield down the minute when it's transferred. That's actually like an active asset that is working for you, and I think that's a really exciting thing. I think the question about like what is money and how is it utilized, like that asset can actually be now used in a peer-to-peer transaction. So now you got this like very active yield-bearing asset that is a money market fund that is kind of sitting like alongside stablecoin in the same thing, but is not a stablecoin, and I think that's really exciting. I think similarly, we've seen a couple other really cool projects. Etherfuse is a portfolio company of the foundation, and they actually do this thing where they're tokenizing bonds in Mexico, tokenizing bonds in Brazil, and actually it's creating local value for yield, and it's creating these new use cases and opportunities. So I think that's going to be kind of the opportunities that split out of this as well.
Distinction here in terms of the money market funds is that they are actually money market funds. They are securities that are wrapped in Web3 technology that allow them to move on blockchain rails. And so because they are money market funds, they are typically issued under the 40 Act, and they are securities, and they are able to pay interest. And so if we differentiate, we want to be really specific about the Genius Act, is it's specifically talking about the ability for stablecoins to pay interest, which would be in the eyes of the banking lobby directly in competition with banks and others who are paying interest. And that's something that is a regulated and permitted activity. What stablecoins generally do today is they pay rewards. And so the idea behind a stablecoin is that, let's say you're the issuer and you capture today's Fed funds rate, 3.75%. That's your net interest margin. You can choose to pay some of that out to support your ecosystem partners who are helping you with liquidity. You can choose to pay all of it out to attract users into your product so that they use your product over somebody else's. If something's structured as a security, like a money market fund, the disclosure rules and the regulatory posture of that asset is that they're going to pay all of the yield to the holders of it under the rules of the issuance of that product. So there's a really important distinction in the Genius Act where it's talking about stable coins. It's not talking about securities. And the question here is, if stablecoins are truly a much more fast and efficient, permissionless, transferable asset, it is my cash, and I can send it all around the world. I don't want to have to be forced to go park money into a bank where I'm earning savings and interest rates. I'd rather I just get it from holding that asset. And so, the toggle between stablecoins and money market funds is we want the product that's faster, cheaper, better, and more efficient to be able to do the things that the securities can do as well.
This is a definitional point, right? So like Genius Act very narrowly defines stable coins as exactly as Anthony outlined, something that is backed by treasury held at a qualified custodian. There's only so many things that meet that. And then I think we'll get into some yield questions here in a little bit. But independent of where that yield might be generated from, that model's already come under siege. I think Kyrgyzstan announced today or yesterday that they're launching a US dollar backed with their gold reserves. And so now there's a question like, is that a stable coin? Will the US permit that? How will soft power come into play? And so, whether or not it's backed directly by a T-bill, by definition means it is not a stable coin. And then the open question is, okay, well, what are the other models that allow you to achieve dollar neutrality in settlement, but maybe derive yield from other places?
Yeah, so maybe leaning into that a little bit, there could be a variety of reasons for that. One of the obvious ones is that if the economy slows and the Fed needs to cut interest rates, and we get back to a lower interest rate environment, a near zero interest rate environment, what are the impacts to stablecoin issuers when right now the primary driver is that deposit yield? And what are the other revenue models that may come up? And I think, David, you've touched on this, so why don't you take it away?
Yeah. So, I mean, our position is that as the stablecoin wars heat up, it's going to be a race to the bottom on fees extracted, where ultimately, you're going to go with your technology provider that charges the lowest amount of bips, and then you're going to go with your distributor who pays the highest amount of rewards, as it's currently framed, back to the depositors, right? And so if that's true, and then interest rates get squeezed, well, maybe this is not a very attractive place to park your idle cash. So then the question becomes, are there other ways that you can go and achieve yield while still having a dollar-denominated instrument? And there's a whole bunch of products, there's a whole bunch of people working on different ideas in the space, whether it's trading strategies, more asset management style, or it's different underlying assets like gold that backs the stablecoin. And so, yeah, I think we'll see a race to the bottom in stablecoins as they're narrowly defined, and then we'll see a broadening of synthetic dollars that try to, I guess, complement the T-bill version.
Right, and just to dig into that, and Evan, I'll let you jump in. I mean, the synthetic dollar topic, the Genius Act really clearly defines what can and can't be a stablecoin and what backs a stablecoin. So I think what you're talking about, to be clear, is things that would be for use outside the United States. Is that fair?
Yeah. So again, stablecoin very narrowly defined. I think the dollar instrument backed by gold reserves held in another country is like a super interesting, not only thought experiment anymore, but now an actual thing that another country is doing. And so it really does open the question of, like, are we going to impose that this is the only medium and it has to be, held with a T-bill? And then, like, how can we impose that, right? And, like, what are the levers if it's on a decentralized blockchain network? That brings into question, how decentralized are these networks? Anyways, lots of follow-on impact.
Yeah, and again, I mean, one of the questions that I wanted to ask, and we won't have time to ask, is the impact on the T-bill market if these stablecoins really succeed as people expect. Is there going to be some negative knock-on impact to the market? But Evan, go ahead.
Yeah, I mean, related to what we're talking about, I think at least our view or my view is it is really hard to keep the genie in the bottle as it relates to innovation. I understand we're talking about kind of pending legislation and recently passed legislation, but if you look outside the U.S., just at on-chain products like Athena, which is you can debate whether it's a stable coin or not, but sort of stable and fueled by funding rates and the base rate.
Not a stable.
Not a stable coin. Not a stable coin. Yeah. But functionally, some people think of a product like that as close enough. So I do think there is room to innovate, but of course we want to encourage innovation in a way that still preserves at least transparency, so that end users, even through layers of obfuscation, know the risks and sign up to that when they maybe have exposure to it. But that is definitely something we think about. Like there's certainly risk to that as well, but innovation is almost always net good at the end of the day, so long as it's adequately disclosed.
I think there's you want stable coins to be safe and trusted so that people can use them and we don't create systemic risk. And the UK, yesterday or day before that, has just passed a new, I don't know if it was legislation or a ban on stablecoins, citing systemic risk. And the reason they did that was because 80% of credit in the UK comes from the banks. Right. Here, it's like 20 or 30%. So their view is if stablecoins proliferate here, it's probably going to cause us a lot of problems, and we need to figure out what those problems can be if a stablecoin itself is not something we can trust. In the United States, US T-bills is the thing that backs all the stable coins. USDC is the dominant one. Here, the Genius bill is going to specify exactly what goes into the collateral package behind those. It's T-bills, it's short-term, it's paper, it looks just like a money market fund. One of the really big things that's going to change is whether or not the Fed gives Fed window access to those approved issuers. So right now, it's only a handful of GSIBs that have access to the Fed window for emergency funding, for swap lines and stuff like that we do inside the U.S. Governor Waller has been outspoken about wanting the stablecoin issuers who are approved under the Genius Act to have access to the Fed. This would allow USDC and other U.S. Genius Bill issued stablecoins to proliferate globally, and if they have some kind of issue that maybe feels like it's systemic for various reasons, if there's a DPEG on an exchange that changes the price of that asset, the issuer has the ability to go to the Fed and pull on and draw on a line instantly. That's the thing that's going to bring, it's a little bit of the nail in the coffin in terms of like your first order is use that trusted stablecoin. Your second order is go and use the Kyrgyzstan gold-backed stablecoin.
Right. So in the seconds that we have left, what the hell is water? And will we be talking about stablecoins, or will stablecoins be money? So, quick fire, is that going to be the case, and when? Go down the line.
Yeah, as we talked about, the winners here are people who can provide the redemption or access to a Fed fund window, and then people who aggregate, the customers at the interface. And so you won't talk about stable coins. It'll just be, some name brand loyalty token or name brand dollar associated with the brand, and then on the back end, it's probably USDC.
Stablecoins are still just a nominal asset. You should just go buy Bitcoin.
I think about stablecoins to cash is like WhatsApp to SMS, in that it is now like WhatsApp is the global communication mechanism, and I think that's the same thing that you're going to do, and so you're going to transition out of it, but it is just better money.
Yeah, better money is a great way to put it. I think Bitcoin has sort of abdicated the medium of exchange and the unit of account in some ways to other technologies and stablecoins that filled in the void, which is great, but no reason you can't have both in your wallet.
So thanks, guys. The answer to the question to what the hell is water is better money. And with that, I will leave you. Thank you so much for your time, and have a great afternoon.
Thank you.
Thanks.